All right, what's up, mortgage coach and trust engine community? I am at the HousingWire Annual event, as you'll notice in the background, and it's been incredible. There's been so many industry leaders, so many change agents in the industry, so many innovators, and lots of presentations on what are the right things to do in this market. We are going to be on a panel tomorrow. It's called Moneyball Mortgage, and I first did this interview with Jim Deitch. I don't know, what was it, Brian, probably 3-4 weeks ago?
I think so, yeah.
Roughly. And I really felt it was the beginning of a very important conversation, because we can't just keep doing the same thing in this mortgage industry and expect profitability. Like, there needs to be some real drastic change in how, especially IMBs, manage the business. We're going to call it Moneyball Mortgage. I've got the two gentlemen who are both industry leaders. I'm going to have you guys just share like a minute of who you are, James, for the audience.
Sure. James Hecht. I'm head of production for Newrez, and that is, we're located in Fort Washington, Pennsylvania, with offices across the country, and that includes responsibility for our channel, for our distributed retail channel, our wholesale channel, direct to consumer, as well as our joint ventures. So excited to be here and talk about this topic.
And I want you guys to think about his role. This is a man who's been with multiple lending platforms, multiple channels, and he's data driven. We'll talk about that more in a few minutes, but there's just a lot of wisdom that can be pulled from the different experiences that James has. Right.
So hi, I'm Brian Hale. I'm the founder, CEO, and primary consultant for a firm known as Mortgage Advisory Partners, which is my consultancy firm. Some of you may know me. I've been in the business. This is my 41st year. I had the good fortune to be the CEO or president or leader of some of the largest mortgage operations in the country. And I agree with you, Dave. It's been a great conference, and looking forward to the rest of the discussions. Started my career as an originator. I was a top originator individually for a long time in retail, and I've had the good fortune to run the largest retail, the largest wholesale, one of the largest joint venture teams, and a large correspondent team. So I also kind of bring a little bit of a multidimensional piece to the equation. And today I spend time advising companies of all sizes on a variety of topics, including M&A, but also in terms of improving their P&Ls and other operating challenges that they have.
Yeah, and Brian is modest. I mean, when he was an originator, he did over 1,000 loans a year. So, I mean, he ran a mega team before mega teams were mega teams. And anybody who's been in this business for a long period of time, first of all, they know Brian. Many of the CEOs and leaders in the industry have worked for Brian. But he was head of production for Countrywide. So he's really got a vast experience. And again, data-driven. This is why we're here to talk about Moneyball.
Data-driven before data was a cool word.
That's right.
When you did all those loans, right? That was by hand.
Yeah, exactly. Yeah. Thank you, James, for that. But yes, it was ink and quill, parchment paper, that kind of stuff's a long time ago.
Yeah, back in the pre-typewriter type things. I remember handwritten out myself.
Yeah, exactly.
So Brian, what does Moneyball Mortgage mean to you?
Look, Moneyball, for those of you who've seen the movie, and know the story of Moneyball, it's completely changed an entire sport of baseball, professional baseball, really all baseball now, of using data to drive a team, to drive a business, to drive success. And instead of focusing on emotion and gut and how we feel about things, to actually go out and understand the data behind success. And so to me, Moneyball Mortgage is really about simply taking that to the next evolution in a mortgage sense, that, as tough as the industry is today, a lot of people are still a little bit managing by gut or by intuition or how we've done it for 25 years. And in many cases, at least in my business today, I find that to be not a great strategy, and not understanding the data that helps drive their business down literally to the originator level, and understanding things like product mix and price exceptions and cost of credit bureaus and those kinds of things, and lead conversion and all of that, to understand which originators, which parts of your business, or in James's case, he's got multiple channels, which parts of your business are actually making you money, which parts of your business are putting you out of business.
Yeah, and I would just add to that, to every originator listening to this, when I did the interview with Jim, there's 3 tiers. Top tier, profitable loan officers that are having, making thousands of dollars per loan for the company. Second tier.
And for themselves, by the way.
And for themselves. By the way, that's the thing. If you are a super successful loan officer for your company, you're also super successful for yourself. Middle tier, which are, losing 100, making a couple hundred, then the bottom tier that are losing like $5,000 alone for the company. And again, we are in a time in the market, so that's never been good business. But now it's causing a lot of forced sales of organizations, and it's causing people to go out of business.
It's non-sustainable.
It's completely unsustainable lending.
Right.
So what is Moneyball mortgage to you?
I will put just a little bit of a different twist on it. When we think of these topics, right, and you said anything from measuring top of the funnel credit to concessions to where the loan officer falls on that scale, I thought that was a great way to think about it, right? But what I look at it in our business is so often companies, originators get saved by a period of lower rates, right? And when you look back at the history of our business, go back, I started in this business in the early 90s, and I can literally point to every couple of years, year and a half, right? You get a little bit of a rally, the refis come in, and what it would do is it really allowed you quickly went into focusing on operations management and staffing and cost per loan from that perspective. And it took all the pressure on understanding the important metrics that are on the front end of the business. We almost got there in 18, right? If you think of how hard late 17 and 18, and then boom, what happened? 19 was a phenomenal year in the business, and it went right back into it. Mm-hmm. Now we're in a period of time we're not going to get saved. And so what we have to do, when I think about it, you can call it, as Jim did on that call, money mortgage or Moneyball, however you want to look at it, it really is getting originators, companies, focusing on the metrics that are away from operations on the front end of the business. And more importantly, what I would say on that is you can't look at it once a month. That's right. Once a week. This stuff changes.
It needs to be living and breathing in real time.
It is. I mean, you just about the time you think somebody, take your example of a loan officer in the top tier, they can go from the top tier to the bottom tier in weeks and not even know.
It's a really good
change in product mix is a great example, right?
That's right.
Yeah.
One thing I'd just add to that, to James's comments, if I could, is I think one of the challenges I see in the industry is what I call aggregation of data. In other words, they look at averages at the top of the house. And I had a mentor that had a big impact on me, and I suspect on James in a past life as well, where his view of averages, data, thinking of averages and what your average loan officer do, is data or statistics for the weak of mind, because it takes the bottom. The old thing about averages, you got one foot in the fire and 1 foot on ice. On average, you're doing fine. Mm-hmm. In both cases, you're in trouble, right? Kind of thing. Right. And so the disaggregation of data and thinking about the way Jim does in terms of segmentation, individual originators, and then adding James's idea of continuous refinement and assessment, because that originator, and it's just odd in our business, can go from a top third to a bottom third with a change in product mix in their market literally within a month or two. Mm-hmm. And if you're not paying attention, all of a sudden somebody you think is making you a lot of money as a company. And by the way, we're talking about companies, but to your point, the best friend an originator has in this business, in my opinion, is to work for a profitable mortgage company.
Right.
Because profitable mortgage companies invest in training, and they invest in technology, invest in marketing, lead management, those things. Companies that aren't making money have a really hard time making those kinds of investments. So it's not just about the company, it's about originators knowing their value, the value they present to the company, and to be successful.
Yeah, and so I want to bring a few things for anyone watching this. If you watch the movie Moneyball, you'll remember there were scenes that not only helped them recruit the right players, but it actually helped them coach the players when they were able to tell that. And the best players want to be coached. The best players want to know what their conversion rate is and how their conversion compares to their peers. The best players want to know their price concessions and how they compare. Mm-hmm. So what are your thoughts on this? Is not only great for companies, but this is great for loan officers. And then I would love for each of you to share, what do you think are a couple of the top metrics that really drive that top tier loan officer that's successful in a sustainable way? So
I think I'll start with piggybacking on your comment. One of the other problems in our industry, right, is pick any organization, and even if you have a flat-ish organization and you've reduced the number of layers between an originator and CEO, there's still people in between, and so one of the biggest challenges even if the leader of the company understands everything we're talking about, they've got to go out and get the organization in that direction. They've got to teach and coach the leaders so that the leaders can then spend that time with the originators and have them understand.
Really good point.
Brian taught me something years ago called the rule of 50, right? It's 50 times, and you tell somebody something 50 times. On the 50th time, they say, "Oh, you talking to me?" Right?
Yeah, right.
And I think that's part
I
of.
hear you now. Now
Right.
I understand.
Exactly.
It's not even to hear you. You talking to me?
Right.
Couldn't be me.
And I think that's a fail and I'll throw myself in that camp is you have a meeting, you talk to somebody about it, and you don't reinforce it. That's probably even before we get into what are the metrics and how you look at them, it's bringing the rest of your organization along for the ride to understand that why.
Yeah, and that constant reminder for all you originators listening to this, it is going forward in the mortgage business, it is a conversion market. I had breakfast with Ron Stowers, who's the Chief Strategy Officer for Homeowners Financial here at this event, which, by the way, love this event because what's on stage is amazing, and the meetings that you have. And he gave me an analogy. Tell me if you like this. He said, for my entire career, we've been running downhill. Like, executives,
Most of
we've been
anybody in
running
the industry
downhill.
have been running downhill.
Yeah, and now we're going uphill. And it takes a different mentality. It takes different skills. It takes a different rigor of strength to make decisions. And it's not like it's going to your point, we're not going to get rescued. Like rates, 63% of mortgages are 2 or 3, and we're never going there again. So really going forward, you've got to be great uphill
80%
runner.
or sub 4.
Yeah,
Sub 4%.
80%, guys.
Sub 4%.
That is a seismic shift for real estate agents and mortgage professional. And by the way, every mortgage professional listening to this, there's never been an opportunity for you to bring leadership to real estate agents and help them play Moneyball real estate. Start measuring their conversion.
Yeah, I think that's a great point. Actually, is the more and you said it earlier. Originators, the best originators, they want to win on all accounts, right? Mm-hmm. They want to win by helping their referral partners win. They want to win by delivering for the company. They want to see themselves at the top of the charts. And the more that we can do to have them see the metrics, make them part of it, bring them into the process versus, just go out and show me the volume, which is what, has historically been, that's how you win.
Look, to James's point, to your question of why was it good for an originator as well. Look, the idea of helping an originator understand that the opposite is true of what I just previously said too, which is, somebody could go from the top third to the bottom third pretty quickly. In some cases, good originators that do a lot of volume, a couple of small tweaks, they can go from the bottom third to the top third like that, right? Just by understanding and knowing. And in many cases, they simply don't know the errors they're making or the mistakes they're making that's creating that problem. And coaching, to your point about Moneyball, the guys, take the first pitch, improves your on-base percentage, right? Those little
You remember
little
that?
bitty tweaks. The movie was on like last weekend.
Yeah.
Just at a random, I came across it. And my point being is, if I was an originator, and I was, when I was woolly mammoths walk the face of the earth kind of thing, but if I was an originator today, I would want to know my value to the company.
Right.
All in, fully loaded with everything. Don't discount this and take that away and forget this and just say I do a lot of volume. I want to know my value, because if I'm negotiating my comp program with you, if I'm looking for you to support something that I'm trying to support or to invest in me, I want to know that I come to you and say, I'm making you $5,000 a loan. I'd like a couple $100 back on each loan invested in this approach. Versus if I know that I'm losing you $5,000 a loan, that's a totally different conversation. So if you want to control your own destiny, know your value to your organization, and help yourself by helping your boss. Help yourself by helping your boss to be profitable, then they can invest in you.
Yeah, and here's the thing. I mean, the most successful mortgage advisors are competitive.
Yes.
Right now they kind of have one scoreboard to play. Here's how many loans I closed. This is what my volume is.
Here's my W-2.
Yeah, and I think loan officers like to know what their retention is. That's one of the things you guys do a great job of, is just really helping your originators understand, retention, conversion, PEs. And then you made a good point when we had our last conversation in product mix. Are there other things that should be measured, Moneyball measured out there in the market for loan officers?
I mean, those are, you could go each one of those categories.
You could subs.
Right. There's probably
Subsections
10
of those.
underneath
Right.
them. And then how you measure it. One of the things too is this business, we get caught up on the BIPs, right? We think a lot of people are like, because they're paid in BIPs, right? Originators are
Basis
typically paid
points.
in BIPs. But the reality of it is BIPs, back to Brian's point, like an average is, BIPs can also be misleading when you think about loan balances, particularly when you look at how fast balances have increased and you start to look at the average. So if an originator whose average loan amount is in the 400 range versus an average who's in the 200, you have to look at all those metrics very differently because you have to do the comparison of basis points versus dollars per loan. Yes. And it's a key piece. So I think the metrics, you hit it right, but it's also how you look at those metrics at the originator level.
And I would add to James's previous point, how frequently you look, right? Because if, I walk into companies today, still to this day, as difficult as the market is and where people's P&Ls are, and they're like, what did you make last month? Well, we don't know yet because we don't have the financials and it's 3 weeks into the next month. That, to me, that's like flying an airplane with the windows blacked out at night and no gauges. Right. How do you know? Should you pull up? Should you drop? Should you land? Should you go left? Can you avoid the mountain? Right. And so that ability to get the data, look at it frequently, and look for changes in trends early. It's what I refer to as looking around the corner, right? A good analyst for me, I want them to look around the corner, not tell me what I'm doing today. Tell me what they think I'm going to be doing a month from now or 2 weeks from now. In that process, now I can make adjustments. And that same coaching down to an originator, to James's point, if you're going to be a data-driven organization, the whole organization has to eat data. Yeah. You can't have one guy, the CFO, the chief production officer, the head of financial analysis. It can't be that single voice that's crying in the darkness, right? Saying data, data, data. Right. The organization has to speak data in the vocabulary and the topics, and everybody has to be on the same vocabulary. I had a mentor really early in life who said 90% of business problems are vocabulary.
Yeah.
If you say processor in this business, how do you define a processor? He defines it different. I define it different. So we're having this debate, and we're not even using the same language.
Right.
How the hell could we come to a consistent approach? You have to define the data, publish the data, reinforce the data, to James's comment about rule of 50. Repeat it 50 times, another 50 times, another 50 times. Are you talking to me?
Yeah, right.
The other point too, Dave, and it goes where Brian was heading on data, is if I'm an originator in this business, everything that we're talking about, there's one word that they really need a company that believes in, and that's transparency.
Yes.
Right. Yes. This business had become, well, we've got the P&L that we show the originators, and then we have the other P&L, or here's what happens in cap markets, and originators want to work for a company that are willing to show them. You said it earlier, but here's my value to the organization. In order to do that, everyone has to be on the same page and transparent.
So I want to play off of that, because not only do you as originators want transparency, but your borrowers want transparency. And your borrowers, one of the biggest challenges in the market right now are price concessions. And one of the best ways to one, have less price exceptions, and two, have smaller ones. According to Optimal Blue, the average price concession, just one concession, is like 80 basis points, which, is high. I mean, it's
shocking.
It's shocking.
It's more than most companies have historically made net.
Yeah. So now, again, I talk to a lot of different lenders. Not everybody is that high, but most people I talk to, it's higher than normal. And one of the things that I advocate is that when you negotiate a price exception, don't negotiate with basis points and interest rates. Negotiate with dollars. Like, hey, let's look at the cost between that half point better you're getting at this lender versus me. That's $2,000 over a year. Mm-hmm. And everybody knows they're going to be able to refi within a year or two. Mm-hmm. How about if I throw in $500, $1,000? Even if it was $2,000, that's better than negotiating with basis points.
Yeah. Now you're on a hot spot for me, because I think one of the things I've witnessed, I've had tens of thousands of originators work for me through the years. They have a tendency to quote price exceptions in quarters, halves, or wholes.
Right.
How about a quarter? How about a half? How about 75? It's like an auction, right?
Yeah.
You know, who's going to bid, right?
Yeah. And those are all very expensive.
Yes, and the difference is, in many cases, if you convert it to dollars, what's it going to take for me to get your business instead of you going to ABC Lender, right? Well, you're $212 off. Okay, $215 price exception, which may equate to 0.007296 of a price exception in basis points. That deal gets the originator his commission in a deal, gets the company the optimum revenue, as opposed to giving it away in big chunks. And to James's point about speaking in basis points, I can tell you that if people used, you know, I use the phrase of, you know, $1 at a time, right? Tell me when we have a deal, right? Mm-hmm. And that one change would be huge in the industry if people kind of took that approach. Right?
And I think the other piece too is, you know, part of the driver of concessions is it's become harder and harder to know where that market is, particularly in the retail place, right? Mm-hmm. On the wholesale side, there's you know, pricing engines that you can get very accurate. Obviously, correspondent is a whole different animal because you know it's a bid price. But on a retail originator, as they're out competing, right? And I do have a level of sympathy with them, trying to figure out where do I need to be, knowing that I've got this credit union in the market, and you know, clearly selling the benefits of the company is important. But what we can do to help them on that is, back to the use of data, is the more frequent, where do they stand on their book of business? What's the profile of their book from a product perspective? What's the profile of their book from a gross revenue? What do the concessions look like? How does that compare to other originators in the market? How does that compare to, you know, the more data that we can drive and help them understand is back, you know, adding to the strategies that the two of you talked about. It really helps them drive down that.
Can I just mention one thing that I think is really preeminent right today? You talked about the guy who said he's been running downhill his whole career, right? I started in 1982. Rates were 15.5 and 3 points, and they immediately went to 17.5 and 3 points, right? Mm-hmm. And then since then, we came down to 21, right? That's been the ride. It's been up and down a little bit, but basically down, right? If you've been an originator in this business and you joined the industry in the last 20 years, you've never had to sell discount points. Mm-hmm. It was always a par price, so you could quote a price. Today, with driving some of that 80-some-odd basis point price exception, is people are uncomfortable or don't have the skill or the strategy to sell a discount point to a buyer or a seller and explain mathematically, if you pay 1.5 points and you cut your payment by X and you're going to stay in the house 7 years, here's the value you got back on your investment of the discount points. Instead, what they have a tendency to do is want to PE the discount points away to get to the rate that they need to qualify the buyer. And that training and skill, we actually do a fair amount of training in my organization for companies on a contract basis. I have a client who spent 2 months last year teaching their entire sales force how to sell, deliver, and strategize around discount points. They're net profitable year to date, and that's not you know, an accident. No. It happened because they essentially took price exceptions, converted it into a sales strategy. I mean, this is right up your alley in terms of the delivery, the mechanism, the tools to do that, and it dropped their price exceptions dramatically and increased their volume simultaneously.
Yeah, and we are at a point where those best practices, and we see it, I mean, at Trust Engine, the loan officers that are following that best practice and how they deliver rates and fees to a consumer, how they negotiate exceptions, are like 20, 30, 40 basis points more profitable. So I have this thesis. I've got a couple more questions I want to ask you guys, but I have this thesis that if the industry took the chaos and the pain that we're in, and we really started, like, let's train our loan officers on how to negotiate a price exception in the most efficient, most profitable way possible. And remember, loan officers, every time you're in that, you're risking the loan. They'll get more loans. You'll get more profitable loans.
Which is why, by the way, they go from a quarter to 1 point like that to try to seal the deal.
And I believe that just about every mortgage company in America could be profitable right now in this market if it's all about training, it's all about improving conversion, it's all about reducing the leakage of basis points in wasteful ways. They'd be profitable today, and as the market recovers, they would kill it. What are your thoughts on, you know, what do you say the impact is to the industry?
I think first of all, the impact spend a lot of this time talking about concessions and that piece, but you just opened up, I guess the analogy top of the funnel, right?
Yeah.
You went right back up there. I think the leakage there at the originator level.
Well, it's 4 times.
Yes, because you can't even get to the price exception discussion if you miss. And so being able to understand whether your company provides a CRM, whether you have your own CRM, how every single interaction, every referral that you get from a realtor, from a builder, financial planner, every past customer contact, and when you're talking to those pre-quals, being able to continuously incubate those is huge. And well, we know there's some masters in our industry. There's a lot that have not backed everything else. They haven't had to do this. And our ability to help them with tools like your company has, I think is critical of the more opportunity you have to take advantage of those leads at the top of the funnel, right? That's how you're going to win in this market.
And I want to make sure everybody connects. There's loan manufacturing, ran a credit report, that is in the funnel. And then there's above the funnel, that's your database. And making sure that you have your database in a place that's monitored for opportunities and signals. So we do at Trust Engine, and then interacted with, so that you're getting every loan out of that above the funnel. And it's 4 times. And what I said, I claimed, like, if you just obsessed over the funnel and reduced conversion and exceptions, you'd be profitable. And if you obsessed over the top of the funnel, we would be thriving right now.
Yeah, look, to your point, I think a lot of people have a database. Big difference between have a database and use the database, right? And optimize the database, right? Data's great. It's got to be discrete. It's got to be really optimized. But thinking of multiple strategies, I look at James's organization. He leads on that topic. And they have a number of different ways, be it the servicing portfolio, customer coming back, retention, those kinds of things, which is a great advantage. But only if people use and execute on the tools, right? And I think, and again, that starts with data to understand, how am I doing? What is your yield, commission dollar-wise, out of your database year to date?
Right.
Do you know that? Yeah. Right? Because I can tell you that companies that live on databases, they know that. They know that, right?
So let's...
last point I was going to add on that is one of the other, again, I love the analogy, we run downhill when you run uphill, right? So you can tie it right back. When you run down, the attitude is, hey, I did a great job for that customer in my database. They're going to call me when they need me again.
Right.
And that's a downhill attitude. Yeah. The uphill attitude is, I'm going to proactively reach out, and I'm going to talk to them about, maybe it's just checking in, debt, interest rates are up. I'm just going to call in about a cash out refi. They may not need it. They may have everything paid off, but guess what? They had a neighbor's brother's uncle's sister who's buying a home, and you can get that referral, right? And I think it's such a small thing, but if everybody makes
it's a small thing, but it's a big
calls
thing
a day.
And little things make big differences. So Ron Stowers, this uphill, downhill thing, I think it's going to take off. We're going to hear a lot of people talking about it.
He should have patented that.
And by the way, Ron, this is the last time I'm going to give you credit for it. From going forward, we all stole the downhill,
we'll
uphill.
Get a T-shirt made up of run downhill, run uphill.
Yeah, run uphill, and you got to be a great uphill runner going forward in the space. So
that might actually, Brian had one that I had used, and I had to pay him royalties, which was looking out the windshield versus the rear view mirror.
From a data standpoint.
From a data perspective.
Yeah, look at this, by the way, I think the biggest issue in our industry is that, I've been doing this for a long time, managed a lot of companies, and the way you used to forecast is you look at your historical data, your historical revenues, your volumes, what do you think your share is going to be, do the math. A bunch of finance folks came in, helped you understand what that looks like, and you could forecast with not certainty, but reasonable expectation of hitting your forecast.
Yeah,
that all works right up until you realize that your source of the business, realtors, builders, financial planners, whether you're doing social media marketing, whatever, that business is falling off early this year, late last year, early this year at an unprecedented rate, so that for all your historical view of data means nothing against your forward, because until somebody sells a house, there's nothing to finance.
Yeah.
Right? And so that look out the windshield and see what's going on with your referral partners is way more important today. It may change someday.
No. It's not going to change.
Than all of your historical data combined, because it tells you nothing, because we're in unprecedented times.
Yeah, and
that's the data we heard at this conference. Unprecedented times.
Unprecedented time, and I'm here to say it's always going to be like that. And it's actually, if you can execute on that vision, which at Trust Engine we work to help you predict, how many loans you have in your database, and understand your loan officer's conversion. The loan officers that could do what you just said, the lenders that could do what you just said, they have nothing to worry about the future. So here's the last question, and let's wrap up this conversation. And let's start with you. Why aren't mortgage executives playing Moneyball mortgage? Like, hey, how many loans you closed is great, what your production is great, but why aren't we making full transparency? Like, hey, here's your conversion, here's the metrics. This is how we play Moneyball mortgage. Why isn't the industry doing this?
The simplest answer that I would come up with is we've spent so many years doing it, whether it's rear view mirror, down, whatever analogy we want. You didn't have to.
So it worked. It's been working.
It worked, and our business has to change. And so when you think about this change, this isn't something, a marketing move that boom, you put it in place. I mean, this is a way you run the business change. It's hard, right? You have to have the information, you have to have the systems, you have to have the training, and it takes a lot of effort. And quite frankly, I think there's a lot in our industry who are still going, well, next 6 months we're going to get a rate rally. Oh, next 8 months, and the tendency to just wait for that to happen is probably the biggest reason. But I think it's turning. I think people, some of the message that you've got out there, people are starting to realize, hey, this is going to be a different ball game, and I'm going to have to play it different. And I'm hopeful. I think somebody yesterday up on the stage, Jay Permisco, may have said, we need our competitors to win.
Jay was on fire.
Right? We need our competitors to win.
Go Jay Permisco.
And so I hope people do adapt.
Yeah. Your thoughts?
Look, I would emphasize James's point. I think one of the biggest reasons is it's really freaking hard. Second, when you finally get the data and you have it, the decisions are really hard. And you remember, I think it was Staples used to have the easy button commercial. There is no easy button in our business. There never has been, by the way. To James's point, when you're running downhill and margins are fat, things are good, it gets easier. But if you're really data-driven, it's never easy. And so part of it is it's really hard. I walk into a lot of companies. I have a world-class financial analyst that works with me. We ask for this data. Company after company will say to us, we don't have that data. A month later, we're sitting down with the CEO and the CFO reviewing their data. And I get this question from big companies, medium and small companies. Where did you get this data? We got it from you. I didn't think we had this data. You had the data. What you had, it was poorly organized in a way that you could make business decisions off it. And then the second, and third reason is it takes immense courage. And I'm not suggesting that our industry is not courageous, but I think in some cases, the decisions that the data suggests are painful. Our business has historically been relationship driven. People like doing business with people they like, right? And they've built kind of a family culture, and it's all for one, one for all, except it's still a business. And those difficult decisions of pruning the tree for the betterment of the tree, helping people understand how to change their business, and then if they can't or won't, and they're losing you $5,000 a loan, there's really only one solution for that. And that takes a lot of courage, creates potential breakage, you have all those kinds of reasons. And so one, lack of organized, visible data, repetitively updated, where you can make decisions. Almost every company has it. Many companies do not have it well organized or presented in a way that management can decide. And then you have to decide, what are we going to do? And by the way, you can put judgment in that. You can say, hey, look, I think it's going to come back in 3 months, so I'm not going to make these cuts. It's your call, particularly if you're an entrepreneur and it's your company and you've built it over 20 years. I cede your right to decide whatever you want to do with your cash. Just understand that no action is a decision, right? And then you may not like the output. And so I think all those things come into play. And I would just say one last thing is that I think this is truly unprecedented. I get asked this all the time. Does this compare to 07, 08, 09? Not even close. Not even close.
So it's tough. So here's my closing thought, and then if either one of you have a closing thought on top of this. One of the things we've identified is that when a loan officer negotiates price exceptions and they use a very specific format, here's my loan, here's my competition, and they negotiate with dollars, good things happen. So I've been talking to leaders around, well, why don't you make that a policy? Like when you do price exceptions, like you're going to follow, our company's way of doing that. And I talked to an executive a couple days ago, and he's like, "That's hard." And I'm like, what? I'm like, what's harder, losing money and actually having to lay people off, or putting in best practices in the sales, in the conversion process that will make your loan officers more money, they'll make you more money? What's harder? Implementing these. So think about, like, when you look at this data, and hopefully we're going to push you guys to start really looking at conversion by loan officer, concessions by loan officer, letting loan officers compete and have that transparency, and then driving things that drive sustainable, healthy businesses. But always think, like, what's harder, like making cuts? Any closing thoughts?
No, I think you both hit that. It's hard, but you know what?
What's harder?
What's harder? And the companies, we've got some great leaders, great originators in this business. We're going to figure it out.
Yeah.
People are going to do the hard work. We've been through it before.
Yeah.
Look, and I agree with Jay. I think more competition, what I've always referred to as the democratization of the mortgage business. If you went in the 90s, the big banks drove everything. Since then, we've democratized the business back out. And there's thousands of players. It's healthier for our industry. It's healthier for the consumer. It's healthier for the housing stock and industry in the United States to have a broad competitive base of independent bank, brokers, all the above. James has an opportunity to deal with all those folks, right, in terms of all the channels he runs. And I just think that, again, not making decisions is a decision in that process. And you just have to ask, what do you want to bet your chips on?
Yeah, I love it. So for all you mortgage professionals that watch this, hopefully you got more business smart IQ. Like, you're raising your IQ as a mortgage professional. Hopefully you forward this to your executive team. I think they're going to love this conversation. This event put on annually by HousingWire is special. Make sure, if you are not subscribing to HousingWire, I want to thank them for helping us do this. So make sure you go check out HousingWire, subscribe to it, and tell your management team and leadership team they've got to come to HousingWire Annual. Not only is it an event that celebrates mortgage, it celebrates housing. It brings both mortgage and real estate professionals together. Thank you, gentlemen.
Great. Thanks, sir.
Thanks, David.
Appreciate it. Take care, everybody.
Thank you. Take care.